Good morning, everybody, and welcome to this EPC Thought Leadership Forum with Christine Lagarde, the President of the European Central Bank. What we are planning to do today is we have some introductory remarks from Christine Lagarde, a couple of questions from me, and then we will open it up also to the audience. But because we have a limited time frame, today we will not have questions directly from the floor. So if you have any questions, please write them in the questions box, which is provided, and then I will moderate those for the President. Welcome, President Lagarde. It's very good to have you back at the EPC. I don't know whether you remember the last time you were at the EPC. It's a little while back. It was 2014, and you were there, of course, in your role with the IMF, and had an event also with Wolfgang Schäuble, who was then finance minister in Germany. And I looked it up, and the title was Jobs and Growth, Supporting the European Recovery. So in some ways, we're back to where we were in 2014. So it would be great if we could start with how do you assess the crisis and the crisis response we have seen? How can we support European recovery from this crisis? And in particular, what is the role of the ECB in that? Thank you.
Well, thank you very much, and good morning to all those who have logged in. Fabian, it's quite interesting actually that you remind me of this 2014 moment and the title of that dialogue between Wolfgang Schäuble and myself, because we very much face the same imperatives of jobs and growth. But clearly we are in a very different situation. And maybe I'll say a few words about how different I see it. First of all, compared with 2011 and even with 2008 before that, the crisis we're facing is of a health nature, first of all. It is exogenous and it was symmetric. And it was like nothing else that we had seen in recent time, and it has produced impact that we had never seen in peacetime. So the violence of the shock was considerable. And it hit us all. So it has three different characteristics that distinguish it from previous crises. First of all, it really infiltrated through a segment of our economies which is not usually prone to be the first victim of crisis, and that is the service sector. What we are seeing at the moment is clearly a service sector that has been hit badly, whereas the manufacturing, the industrial sectors in general have been much more secure. They've taken a hit, but of a temporary nature, and there was pent-up demand addressed to them in many instances, whereas the service sector has been hit much more severely. What is also particular about the service sector axis that the crisis took is that it affected jobs badly, particularly those which are subject to social distanciation, because clearly the return of activity is much more questionable. And second, it's demonstrated that services-led recovery are much slower than goods-led recovery. So this pent-up demand that I've mentioned earlier on, that is often seen in goods recovery, is not the same in service. To give you a stupid example that I take quite often, is that the vacation that you did not take in April, you're not going to take it again. The car that you did not buy in April, you're buying it now. So that's also what is characteristic of this service aspect of the crisis. The second aspect, and I'll come to how specific the policy has to be in response to such a characteristic. But the second aspect of the crisis, and if my much admired friend Herman van Rompuy is online with us, he will remember that during the last two crises, banks were acting as amplifiers of the shock. In this particular case, thanks in particular to the good reforms that had been done over the last 10 years after the last crisis, the banks did not act as amplifier on the crisis. And what we could have seen by way of complete withdrawal of liquidity, by way of tightening of the credit link to enterprises and households, we didn't see. Quite to the contrary, and thanks notably to monetary policy as well, and supervision measures that were taken concomitantly, the credit to the economy actually continued. And in response to the crave for cash and the crave for loans that enterprises and households had, banks actually responded. And it's visible in numbers. When the sort of average credit growth was in the range of 4% back in February, soon enough in April, it was at 7% and stayed at that level. So that's the second aspect of this crisis. The third aspect of this crisis, which makes it so particular, is that it has violently accelerated trends, changes that were in the air, that were ramping, that we were beginning to see in some sectors, if not all sectors, and that has affected all sectors. And I'm talking here about two things: digitalization, number one, and the green focus, number two. So it has brought about a new way of buying, a new way of working, a new way of paying, which we are seeing in numbers. The way in which people have got used now to teleworking, the way in which we're holding this conference, which would have given us the pleasure of seeing each other, hugging each other, touching each other, this is gone. We're doing that by screen. And we're seeing it in the way people pay as well. We have seen a significant increase of instant contact, of payment by cards more than using cash. And that those changes, they were latent for some, and they have been significantly accelerated in the course of the crisis that we have seen. Now, final key point in my view is that the response to the crisis has been significantly different from what we had seen. Those who lived through the last crisis, European sovereign debt, and the one before, or whether you bind them together, the global financial crisis, we had distinct policy responses, not necessarily well coordinated, and sometimes producing negative spillover effects from one country to the other. In the present situation, we have seen a very remarkable coordination and well-articulated fiscal and monetary policy, supervision and monetary policy. Let me give you two examples. On fiscal and monetary policy, the way in which governments throughout Europe put in place very quickly furlough schemes, partial unemployment schemes, income support schemes that were also supported by monetary policy that kept financing costs at a very reasonable and low levels in order to support the economy. Those two together made sure that about 2/3 of those people who would otherwise have lost their job actually kept their income, and hopefully many of them will return to their previous job. That's one example. Second example, we put in place what we call TLTRO, which is the targeted longer refinancing schemes. Well, that in and of itself was very important in order to fuel banks with an incentive to lend as much as they had previously. But it wouldn't have been enough, probably in many instances, if member states had not also put in place guarantee schemes that encouraged banks as well to lend to the economy, in that they were taking some risk of the bank's balance sheets. So the two together actually helped keep the credit flowing throughout the economy. So that's how fiscal and monetary can play a role. And fiscal is critically important when the crisis is hurting the service sector in particular, because you need in that case targeted measures that actually will help those sectors most severely hit by the crisis. Monetary policy cannot do that, cannot be as targeted as fiscal measures can be. In the supervisory side, You know, I'll never forget around the March 17th, March 18th, when we went out together, monetary policy with a very strong package of the PEP, which is a major and exceptional asset purchase program, and TLTRO in order to help credit flow through the economy. Pretty much at the same time, the supervisory pillar of the ECB went out very quickly to authorize the use of buffers and to encourage banks also to use what previous policies had put in place in order to respond to the tension that the economy was suffering at that point in time. So it's this coordination, fiscal and monetary, supervision and monetary, that actually put together with the wrong tempo and the right tempo and the right coordination actually helped a great deal. That's in response to, back in 2014, you were talking about jobs and growth. Well, we're back here, but I think that the policy response has been much more coordinated and more potent than it had been back in those days. And that is thanks to the work that has been done by previous leaders of the various European institutions in particular.
Thank you very much. Just to follow up on that, one of the other things we did also talk about in 2014 was debt. And of course, the amount of fiscal pressure which was accumulated during the crisis, and the questions around sustainability, and the question on when do you need to get the corner? When is it necessary to also retrench in terms of debt levels? How would you see it in the current crisis, where, of course, we also have a lot of debt being accumulated now?
Well, first of all, I would observe that all countries, if we're looking at Europe, but it's true also beyond Europe, but if we're looking at Europe, all countries increased the volume of debt and the debt to GDP ratios compared with what they had pre-COVID. So all of them, those with little fiscal space, those with a lot of fiscal space, they all had to resort to additional borrowing on the markets. So the overall volume of debt throughout the region clearly increased. Point number one. However, point number two, countries entered into this crisis in asymmetric position. Let's face it, some of them had a lot of fiscal space, others had limited fiscal space. Some had a very high debt to GDP ratio, others had a much lower debt to GDP ratio. And my first observation is that, you know, whether it is the next generation EU, whether it is the package of safety nets that were put in place quite early on in the crisis, you know, focusing on guarantees for companies, on additional unemployment benefits for employees, and on the special package available for sovereigns, those three, and the NGE, the next generation EU package, clearly aim at avoiding a worsening of this divide between the have and the have not. And this is a good thing, because it's a recognition that faced with that symmetric shock, we need to really do more for those that are hurt worse. Second observation is that with our exceptional purchase program, known as PEP by those who follow what we do, we decided that it was critically important, in order to avoid fragmentation, in order to avoid the risk that we were facing then, to actually do away with limits in response to the exceptional circumstances. And that led us to purchase more and different classes of assets. That led us to front load our purchase programs heavily. And that led us to purchase not exactly along the capital keys, because it was needed in order to deliver the monetary policy that we had to deliver. So on those two instances, the fiscal support on the one hand at the regional European level, and the monetary policy that we adopted, we tried to not worsen the divide, and to certainly avoid the risk of fragmentation. Now, with all that being done, it is nonetheless true that some countries will come out of this with a high debt to GDP ratio and with a very significant volume of debt. But once I have said that, once we've all said that, we need to go much deeper into what it is that we're talking about. And we need to look at the interest rate. We need to look at GDP. And we need to look at fiscal space. And clearly on all three accounts, there are some positive elements or elements that need to be worked on. I think it's clear to everybody that observes monetary policies around the world that interest rates around the world are going to stay low for quite a period of time. So that impacts on the service of debt. Second, it's also clear, I think, to many of the policymakers that we need to do everything we can to work on the denominator and to really make sure that growth can pick up, that sustainable, green, digitally based growth that is necessary with the appropriate number of structural reforms in order to facilitate that. So clearly, if your GDP is larger, it's going to significantly change the debt sustainability that we are talking about. And finally, clearly at some stage, not now is not the time, because fiscal support is needed and accommodative monetary policy is needed, both of them, for a period in order to take us through the hard, difficult time that we are going through until we are, as I call it, on the other side of the river and on firm footing. But once that happens, clearly there has to be proper, adequate public finances to support sustainability of the economic situation and sustainability of debt. But all three need to be identified as clearly important for each and every country.
Thank you. And to follow up on something you said, yes, we have a symmetric shock, but we have a very asymmetric impact. What can be done to address that asymmetry, both in terms of asymmetry between countries, but also within countries? And there's also a question here which talks specifically about intergenerational solidarity, and that many young people are going to be hit badly by the crisis, given that they work in the service sector or are not in the labor market at this point.
I would say that the young people in particular have to be the focus of specific fiscal policies. And I would say that women are also the other category that could be the clear victim of the current situation, because we find women's employment much higher in those service sectors that are going to be hit and that have not yet been even authorized to function again. You talk about hospitality, you talk about some transportation, you talk about restaurants, you talk about tourism, travel, entertainment. Those are sectors in which there is a very large number of young people and women who are employed. So I would say that first and foremost, it's critically important to give the income support that will sustain them throughout the crisis, and concomitantly to make sure that they can be offered the training, the skills, the skill setting or resetting that will help them at the on the other side of the river to actually again find activity that might be different, both in terms of the way it is displayed and discharged, or maybe in different sectors, if some of those sectors are still affected and likely to be affected for the long run. So I would say, number one, fiscal support in order to make sure that income is maintained, and continued support in order to help them on the other side of the river, make sure that they can, stand on their feet. This is critically important. I would say number two, because we're not exactly sure where demand is going to come from. We need to make sure that economies from the supply side are actually adequately fit to respond to wherever that demand is going to come from. And there is clearly, one thing that comes to my mind, because it's on the agenda, has been for a long time and needs to be completed. And I'm talking here about the Capital Market Union. It's clear in all the research and all the work that is done that equity-funded firms are more solid, they leave a better climate footprint, and they're more conducive to creation of jobs. So this is an area where clearly we Europeans have to do a better job, and in order to respond to what will come. People who are prepared to start up their business, young entrepreneurs who've been dislodged from a particular segment who are going to reinvent themselves in another one. Well, we have to make sure that the financing will be available. We are notoriously less good than the Americans in particular in order to provide the financing. We need to make up for that. We need to facilitate the financing, and we need to support those young firms that generally, firms under 5 years of age provide about 1/5 of employment, but they provide 1/2 of jobs growth. So that's where I think we need to put the focus. Income support, training support, and making sure that the ecosystem is fit to respond to the starting of activities.
Thank you. Picking up on something you mentioned there in terms of the transitions, both the digital transition and the sustainability transition. There's a question here from Heather Grabe. How can the ECB speed up the transition to zero carbon and support the European Green Deal? And at what point will the ECB start applying the new EU taxonomy for sustainable investment in its own risk assessment?
Well, first of all, I celebrate the fact that the Next Generation EU and the RRF in particular have identified 20% spending on digital, 30% spending on green. And I think that is a very, very powerful, not only message, but direction given to where budgets should go. And this is not lip service, this is real money, and it's a significant amount. If you look at the overall package, we're talking about close to 5% of the European GDP that is going to be directly invested in those areas. So that's on the one hand. How can the European Central Bank, how can a central bank help in that respect? Well, first of all, I would say that maintaining price stability in and of itself, which is the single mandate of the ECB, is indeed conducive to investment, to job creation, to economic activity, and that is what is needed. Number two, I would certainly strongly support the view that price stability in and of itself includes climate change imperatives, because climate change has a direct and indirect impact on price stability, on the level of inflation, on the capacity of people to save or not save, on the concern that they have about the future of the economy. And all those elements combined come into the price stability objective that we have under the treaty. So climate change imperatives, if well articulated and identified in their contribution to price stability, will actually have an impact on the monetary policy that we decide. The second aspect, which is something that I have said and which will be debated as part of our strategy review, is that when externalities are not properly priced in, well, it produces asset prices that are not necessarily correct. And I think that correction hopefully will come into play. And I think that there is one particular pool of assets that would be perfectly appropriate when the instruments are in place. And that's the volume of collaterals that we have in stock, so to speak, and in flows as well, because we're continuing that, in consideration for the lending that we give to banks. We, I think, would be perfectly justified once the taxonomy is in place, which is January 2022, and hopefully improved upon, because for the moment I see it as a fantastic step forward, but not complete step yet, because we need to understand the various shades of very gray to not so gray to, sorry, the very green to not so green to not green at all. And that needs to be better identified. And I know that the Commission is working hard on that, that we would be perfectly justified to apply that to the collaterals that we take in, because that would help us actually identify properly from a risk management point of view, from a financial stability point of view, what assets we take in as collaterals before we lend. So that's one contribution which I hope we can put in place, hopefully quite soon. But clearly, taxonomy has to be effective, which I understand will be no later than January 1st, 2022, so in a year's time, hopefully improved upon, and that would help us certainly have a robust discussion during our strategy review and hopefully delivering on that basis.
Thanks. You mentioned the MFF and the recovery plans we have. How important do you see a swift agreement on these for the recovery of the European Union, given that we still have the uncertainty at the moment?
The MFF and the recovery and resilience plans made a huge impact when they were decided. It changed people's attitude towards us, the Europeans. It showed that we were capable of coming together and putting money where our mouth was. That was a game changer in my view. In terms of its completion and implementation, what matters is its size. As I mentioned earlier on, it's a large package and it's important that it be so large. It is structured by way of, concerning the RFF, the Recovery and Resilience Fund, it's partly grants, partly loans. That's also a very important component. And it matters that it be implemented in short order over time as is planned. So it's well sequenced over the course of the next 3 or 4 years, but it shouldn't be allowed to be delayed significantly, because then I think that would be a cause for disappointment for those who suddenly saw back in July a cause for real hope in Europe.
Thank you. A final question. Unfortunately, we only have a limited time, but just to raise the global question. We have had a significant political change across the Atlantic. What would you see are the priorities from an ECB point of view for global cooperation, and in particular, potentially working with the new White House?
Well, from a central bank perspective, we have enjoyed, I have to say, a very, very good cooperation with colleagues at the Fed. So we have not, as central bank, suffered from any kind of refroidissement of the relationships between the two sides of the Atlantic. My hope, as having been partly brought up in on both sides, is that the relationships will improve. I don't think that they will be necessarily massively different, but I would hope that the multilateralism that has been at the heart of relationships, with its downside, with its procrastination, with its laborious developments on occasions, will be reset and reinitiated between those two sides of the Atlantic. That's my strong hope, and it's, as Churchill would have said, it's better to chat than to war, be it in trade or be it in other fields.
Thank you very much, President Lagarde. Unfortunately, the half hour is up. There were many issues. I could have gone into more detail, and I couldn't get through all of the questions. So it shows there's a lot of demand to hear from you. So I hope that we can welcome you back soon at the EPC. Hopefully also in person, if that is possible again. But for the moment, thank you for taking the time out to talk to us, and thank you to all the participants and the questions.
Thank you very much.